Thank you very much. Good morning, all, and welcome again. Here, actually, we have distinguished panelists. Mark Davis he's a partner at Element 22, and Donald Gillis, he's CEO and co-founder from Passport. Welcome again. Today we are going to discuss how the automation is going to enhance the performance of various processes, especially KYC and onboarding processes. As we all know, digitalization of any sort of processes prospering basically on the foundations of cutting edge technologies. That could be machine learning or AI techniques. So all these techniques are going to be used to enhance the underlying processes so that actually we could bring more scientific approach. So now we are going to discuss how these technologies could enhance and bring more scientific approach to KYC and onboarding. In case any of the audience not aware of KYC, full form is Know Your Customer. And knowing always starts with asking right questions and getting answers to the questions. So it's all about asking the right questions and getting the answers and verifying the legitimacy or correctness of the answers that we get for the questions. On the face of it, it sounds so simple, KYC, but in reality, there are many moving parts, and that could easily become more complicated and complex. And I would like to start the discussion by asking simple questions to our panelists. Could you explain what is KYC and why that is so important, especially in financial world, before going into the much deeper questions? Thank you.
Thank you. So just by way of a quick introduction, Mark Davis, partner with Element 22. We are a data and analytics advisory company, so we work with financial institutions and advise them and help them mature their data management capabilities. And that often overlaps with the KYC and onboarding world. So in answer to the question, what is KYC, I think, unfortunately, the answer I can give is that it's different for every organization. Ultimately, I think the priority goal for firms when they KYC is to establish the suitability of a client to effectively to engage into a financial transaction. So that's the primary objective. Is this client fit to be a customer of ours? Do we, in terms of falling within regulations, there are lots of aspects to that from a screening perspective. So often KYC will extend into some of the compliance questions as well, which increasingly focus on the aspects related to anti-money laundering. But also lots of organizations couple with the KYC process the aspects related to different asset classes and the ability to transact in different asset classes. So it may well, for some organizations, be a simple suitability to transact question, but very often now, most major financial organizations have to look at KYC as part of a much broader question around client lifecycle management, the ability to onboard, to trade in multiple different transactions, to be able to report to multiple different regulators. So ultimately there are many questions related to KYC, and we haven't yet seen two organizations that approach it in the same way.
Yeah, I guess the only thing I would add to that from our perspective at Passport is if I like to kind of speak in analogies because I feel like they're more kind of common reference points. If you think about the transformational impact that companies like Salesforce had on the sales and marketing profession, and the sense that those platforms effectively digitize all commercial touch points across any customer relationship. For us, KYC is evolving away from being this kind of checklist exercise where you have to collect certain data points about customers to a world where you're effectively trying to digitize all of the regulatory risk and compliance touch points across that commercial relationship. So for us, KYC has moved away from being this kind of single point in time transaction related exercise to one where it's much more about risk assessment across the evolution of that commercial relationship. And based on what you know about a customer, kind of what products that you offer to the market can they realistically transact. And it's all, as Mark said, it's very much down to the organization. What's their risk appetite? What products do they offer? What jurisdictions do they serve? And how can technology kind of strengthen and facilitate more transactions?
Thank you very much. In case audience have any questions, you can always go to Umbrella app, and bottom of the toolbar you could find 3 dots. If you click them, I can see your questions so that I can pass those questions to the panelists. Thank you very much. Most of the times what happens is, many people are actually nowadays using many digital channels. So on average, an average person could interact with 4 to 5 digital channels on daily basis. So that means people are basically digital savvy. If that is the case, did you see any sort of change in customer behavior when it comes to KYC? If that is the case, what sort of implications we could envisage regarding KYC and onboarding?
There's absolutely a change in customer expectations, and I think in the last, and for all of the reasons that you mentioned around, in our pocket we all have a mobile phone where we can do so many things at the touch of a button, and I think the tolerance for some of the legacy onboarding processes is really diminished as a result of that. So yes, expectations are different, and I think many organisations now look at their onboarding process in terms of touch points. And if we think back 4 or 5 years when we saw lots of major repapering exercises with financial institutions, a lot of those exercises were driven by regulation. So the need to go out and gather more information for maybe FATCA reporting or more information for Dodd-Frank or EMIR reporting, all resulted in lots of letters out to clients. And I think there's been a general reaction to that, which is we need to minimize the number of touch points that we have with an organization, gather as much information as we can up front. We still have many different internal sign-offs in an onboarding cycle in most institutions, whether that's the compliance teams, the reference data teams, the credit functions, the legal teams, all need to, and operations groups who maybe set up accounts and systems, they all need to be involved at different stages in an onboarding process, but that doesn't necessarily mean they all have to independently reach out to a client. And I think that's one of the key changes that we see today, reducing touch points, trying to capture as much as you can up front in a process, and really just simplify the impact on your client. So that's the big reaction, I think.
Okay. From technology point of view, could you explain?
Yeah, so from a customer experience point of view, customer expectations, there's nothing more infuriating than a customer in today's economy than trying to access a service or buy a product and not being able to do so. We've all become accustomed to almost getting what we want when we want it. And I think the old kind of way of conducting KYC and anti-money laundering checks kind of is almost at odds with that philosophically. So yeah, I guess a slight difference in my view compared to Mark's is that actually we've seen, at least in the way that we interact and support our customers, a reduction in the amount of information that is collected up front. And you kind of almost want to try and facilitate that transaction or commercial relationship as quickly as possible to deliver that kind of dopamine hit and a positive customer experience, win the relationship, and then through kind of more closely monitoring that customer's behavior and layering in kind of due diligence tasks post initial onboarding, you can build up a kind of just-in-time view of risk at the customer account level, and then perform the appropriate compliance tasks kind of as the relationship evolves. So it moves away from, I need to collect everything up front in order to onboard you and provide you access to my services and product catalog, to I'm going to give you access to my kind of low-risk product and service catalog, And then if you want to kind of move up the risk levels, medium, high, very high, whatever, every organization is different, then we're going to layer on the compliance processes kind of as that unfolds. So for us, that's the biggest shift that we've seen, and it's the biggest kind of shift from a technology perspective that we have tried to help facilitate. I guess to put that in perspective, we kind of categorize it as two waves of RegTech almost. The first wave was very much about how do you support that old way of doing compliance. So give me access to data sets, and through access to those data sets, I'm going to verify certain information about you as an individual, or I'm going to verify certain information about you as a company. The first wave of RegTech companies really provided APIs to access those data sets in an easy way that developers and fintechs could plug into their platforms. Think of Comply Advantage, think of Onfido, think of companies like this. The second wave of RegTech kind of goes beyond that, and it's much more about how do you facilitate positive customer journeys that are risk-based and tailored to that individual or to that company. And then on top of that, support the workflow actions that need to be performed by back office teams, compliance, financial crime, fraud, risk. So that for me is the technological shift, is you've moved away from just a focus on data and provision of access to data, and then you've now layered on top of that a kind of operating system that allows you to digitize and then start to learn from kind of human behavior.
An associated question from audience. As a CEO or co-founder of a company, what sort of fight within companies do you see while serving the customers with sophisticated compliance and KYC and onboarding related activities?
Yeah, well, I know Mark used to be a CEO of his own business as well, so I'm sure he's got a view on this one. But from our perspective, it's always a fight over resource, namely product and engineering resource. So traditionally, compliance teams, financial crime teams, risk teams, kind of you can associate any of those teams with this statement, have struggled to get access to those resources, partly because they don't know how to speak to those teams within the institution and communicate their needs and, I guess, work collaboratively to design an effective solution. But also just because they've been seen as the kind of naysayers, the business blockers, the team that says no and prevents the company from growing fast. I think part of RegTech's job is to help change that image, that internal image and perception of these teams. And if you can kind of put more structure around how those teams operate, if you can report more accurately the value they add to the customer interactions, the fact that they can speed up time to decision, the fact that they can actually make customers more loyal, then you can start to change that narrative internally. You can present a business case to the CEO that isn't just viewed as here we're going to make costs less or we're going to make the process more efficient. You can actually say, I'm going to help you launch in 5 new countries next year, or we're going to help you take this product to a new market, or we're going to help you take this higher risk product to existing customers. And that's a totally different conversation to have. And for me, that's the main thing we see is that fight over resources, and compliance teams are getting better at winning more resources because they can actually drive change and make a difference now.
Do you have any view on it?
Just one
Quick.
that really jumps out in terms of the fights that we see within organisations is, let's say, the difference of opinion between what the compliance functions lay down as the rules and the teams that operationally have to execute on those rules. And if I give you an example of that, the need to capture the director's passport photocopy in every case, you ask the question, well, do I need to go to Richard Branson and ask him for his passport if we're onboarding Virgin? These kind of questions come up, and I think the reality is that executing on the process sometimes requires the compliance functions to be much, much closer when the rules are set, to really understand what the practical implications are. And I think to Don's point, that's the risk-based approach is really, really critical. I think organisations have to think about the risks associated with the steps that they're asking, but also what the operational implications are. You know, are we creating 5,000 man days effort with that very simple rule that actually add little in the way of value or reducing risk for the organisation? So that would be the big tension that I see, compliance to actually the teams who have to implement the rules.
Thanks, Mark. When it comes to KYC onboarding, we all accept there are 3 key pain points. The first one is data collection. The second one is doing the appropriate analysis, and the third one is creating the risk profile for the customers. We have actually some technology solutions. Could you explain how these existing technology solutions could minimize those so-called 3 pains while we are considering automation of KYC and onboarding?
Question?
Mark. Yeah.
Sure. So I think technology clearly has a significant role to play in efficiency, in clarity of a process. I also see that there are some pretty big barriers where technology hasn't yet helped organizations to overcome. So one that really springs to mind is that the need to capture evidence at the point of KYC is vitally important for firms to understand, not just the digitized data points, but sometimes the need to gather the evidence that supports that. So whether that be a director's passport copy as an example, or articles of association, needing to have physical copies of documents, needing having to have the original signed version of a document as proof. Many jurisdictions enforce these kind of things. So the reality is data capture, yes, that can be digitized and there's an awful lot that can be done with technology. But the need for evidence and mandated need for evidence with many regulations means that there's still an awful lot of manual processing, a lot of unstructured documentation, the need to have effective records management processes in place. Technology can help in all of these areas, but I think that's where a lot of the inefficiency in these processes still exists. So finding the smart balance between innovative new technologies and being able to plug those into workflows and processes to maybe take away the 50%, 60% of the effort, while focusing on those things that we're not yet able to overcome because the regulation mandates it.
Yeah, I guess just to add to what Mark said there, we kind of think of it like layers. So first layer is, as a customer, I want access to data. I need to verify information that you give me about yourself or your company. As Mark said, above that sits your kind of data capture piece. So when the data doesn't exist, or when I need to collect more information from you, how do I do that, and how efficient and how positive an experience is that for both you as a customer and us as an organization? And that's kind of, I'd say, where we are largely today. You're driving automation through connecting to those data sets and then writing some automation logic on some of the tasks that were traditionally performed by humans. That's kind of where we are right now. But if you can get more users to start adopting your solution to, I guess, build out those shareholder maps or add those unstructured documents, if you can add fields to your data structure that then allows humans to take the key aspects of those documents and key them into a structured format, then you can start to create kind of new metadata sets that can drive further automation. So that's what I think is exciting about the future, is as humans start to perform more of the tasks that were previously offline online, then you get this kind of increase in the number of touch points and data points that are available for technology to further drive automation. And I think that's particularly exciting for things like company onboarding, where the data sets globally are very poor. But you can envisage a world where you have this distributed network of compliance professionals that are in real time updating company records that can then be kind of anonymously queried across that network. That's not an unrealistic ambition for the RegTech industry to achieve at some point. And I know Mark used to be involved in a kind of early effort along those lines with DTCC and the KYC utility that was managed between a consortium of big banks there. So it's a vision that the industry's had for a while, and I think through adoption of RegTech, you can actually now start to envisage a path to achieve it, whereas previously there's been a number of like economic and I guess commercial reasons that we haven't moved in that direction.
Maybe just to add one other point to that as well. We often assume, I think, where we do have access to good technology capabilities, that we have the data in place at the start of the process, and that we have high quality information on which we can then apply the technology. And the reality is that that's very often not the case. So a lot of the challenge with applying the new technologies is understanding, where the effective sources of high quality information are that you can plug into those technologies. And there's absolutely a role to play for both traditional and more innovative modern data providers to provide high quality information as input into that process, particularly back to that first point, in terms of how you reduce your client interaction. Well, if you can source information from an external provider and not have to bother the client with it, but you have to be able to trust that information, and there's a real trust deficit, I think, in some of the information that's available today.
While we are moving from manual processes to automation, what sort of the other pain points are the for example, from compliance point of view, when you are collecting data sets, what are the issues? Can we collect the data sets a priori and keeping the data sets on a blockchain, for example? So that actually, the other people need not, repeat the same exercise again and again. If we are going to use these kind of technology solutions, what sort of difficulties that you could imagine, from regulatory compliance point of view?
So I guess taking the blockchain piece first, I think technologically you could definitely support that type of use case today. And I mean, arguably you don't need blockchain in order to achieve a distributed system like that. It effectively is just a database that is in some way trusted. And DTCC and others have tried to create an effective platform previously. The problem often comes from the commercial side. It's more about kind of who covers the liability when things go wrong. So if I make a decision that is dependent on data that's supplied from elsewhere, and that data turns out to be inaccurate, and I've done business with a sanctioned individual, for example, then whose liability is that? Is it mine? Is it the utilities? Is it the person that contributed the data in the first place? And that's a difficult problem to solve as you scale these systems, because the liabilities that we're talking about become very substantial. And then on the kind of counter side to that, a lot of banks in particular, because they're the ones that have been involved in utility projects, ironically, they see kind of aspects of the KYC AML process as proprietary and kind of a competitive advantage for them. And they worry that if they're contributing client data to these shared repositories, then there might be kind of some clever brains inside the bank that can work out ways to back solve kind of whose clients are who, and ultimately try and compete for that business. So those have been the challenges in the past. They're not necessarily technological, they're commercial. And I don't think blockchain necessarily changes those aspects. But I guess in terms of practically speaking, some of the problems that I see in the shorter term, it is really, I guess, this focus on automation that is part of the problem. And I feel like what a lot of industry stakeholders fail to acknowledge, because automation is kind of nice to think about and it's a key buzzword, is that actually compliance often sits in this grey space where you want someone to exercise their judgment, or you want someone to make a decision. These people are meant to be experts, and they are kind of career professionals. So I think you've got to think of it more about like hybrid automation. And the way, I guess a really tangible example of that is if you can have software that, as Mark says, kind of does the heavy lifting on 60-70% of the process, and you can reserve the kind of 30% that actually requires judgment or experience or skill to exercise, then you can start to layer on technology that makes those individuals more efficient. So again, to use an example, you could have specific cases that need to be investigated that you may be able to categorize, and then you could say to a compliance professional, we know from observing how you've interacted with the platform previously that in 70% of these cases you perform these 5 clicks. Do you want us to execute those 5 clicks in 1 click? So you could start to drive efficiency improvements that way, which is kind of this human hybrid concept where over time you can layer on further automation, but you have to do it by, I guess, having more data that is structured, and then also kind of the risk appetite on the client side to actually continue to kind of increase the number of actions that a piece of software can take. And then you need good auditability around that, and you need good reporting around it so that people can continue to be confident that the software is performing as they've kind of envisaged it performing.
Thanks, Donald. Regulation is always sort of a lagging process. It is a sort of continuously evolving process according to the availability of the technology. What sort of evolution that you could envisage regarding the regulation in the near future when it comes to the technology standards?
I think it's very topical. Today's the deadline for a UK Treasury consultation on AML practices, and it's looking at the overall end-to-end, I guess, the regulatory landscape and the way that the government works related to enforcement of AML practices. And I think there's a unique opportunity, I think, to embed new technology in the way that AML is done. Maybe if I can give you an example of that. So we, as Element 22, we coordinate a small consortium of banks who are working together using privacy-enhancing technology, so PET technology, to try to solve a number of different issues. And we see an opportunity for privacy technology in particular to allow a new level of collaboration to effectively to provide insights that each of those firms can't glean on their own. Privacy technology is it's a relatively new set of technologies, but it protects organizations in terms of confidentiality and some of the points that Donald mentioned earlier. So it protects effectively your client list, it protects your identity, but it allows you to collaborate with others by sharing certain information. And it offers some really interesting opportunities. If we think about AML, the AML space, one of the key issues with money laundering is the fact that money laundering will always identify the weak spots in the chain. So typically, it's not within one organization and it's not within one jurisdiction. Often money is being passed to multiple financial institutions cross-border, which also comes back to your last point around some regulatory questions and concerns that are difficult from a technology point of view. And I think where you have those lots of different financial institutions who are all part of a network, unknowingly part of a network, where information is being laundered or rather money is being laundered, the ability for insights to be shared and collaboration to happen using secure technology allows insights that each of those firms can't independently achieve. The same, one of the other use cases we're looking at with this technology is can each firm share insights? So if every organization independently runs their own KYC process, let's say everyone in the room here is running their own independent KYC, and you all have the same common counterparty, which may be a leap of faith. But if within that community, half of the group decide today that actually there are politically exposed individuals associated with this counterparty, if that half of the room or even one person in this room could anonymously notify the network that actually we think something important's changed about this counterparty, that allows everybody else to investigate and do something about it. So whether that's PEPs or whether that's sanctions or whether that's information around ultimate beneficial ownership, we believe that these privacy technologies allow a new level of collaboration, but without risking your own identity, confidentiality in the process. So it's one area where we're responding to the consultation. We want the UK Treasury to get behind these technologies and look at how they can be better applied. The FCA did a great text print on this in May 2018, looking at how privacy technologies can be applied for financial crime use cases. And there's no doubt that new technologies open many, many new opportunities for firms to do things better, to be more efficient, and to get insights that, frankly, each firm can't get on their own.
Perfect.
Long answer to a short question.
Yeah. Thank you very much, Mark. The next, well, you have already mentioned privacy and security related issues. When it comes to customers would definitely prefer convenience, but in addition to that, actually they are also very much concerned about privacy and security, and perhaps they don't want to share their identification details with third parties, or they might be worrying actually whether the given identity details are properly secured or not with using appropriate encryption algorithms. There is a sort of interesting question from audience. How do we see vision for one central source of KYC information coming about from technology point of view?
Yeah, I think the short answer to that question is that I don't see there being a single source ever. I think what is more likely to happen is that you'll end up with multiple trusted sources for potentially different types of information. So just thinking of an example on the spot, like if you look at the Nordic countries, for example, they publicly share tax information. You cannot imagine a world where in the UK you publicly share tax information. That just wouldn't, well, I don't want to say it will never happen here, but I don't think it will ever happen here. So yeah, you get schemes like that, like NemID, which can be used to access a whole bunch of different financial services and other services there. So that's an example of a trusted identity or a shared utility that provides access to services. You can imagine a framework where other countries around the world might develop similar schemes for different purposes, and then you need some sort of way to kind of allow those to communicate with each other, or citizens in one country to access kind of services globally. So that's one example. You could scale it up or scale it down. I think that's ultimately why you'll end up with different sources that need to be kind of knitted together. And that's where this idea of a kind of trusted network instead of a trusted kind of repository is probably, in my view, the right way to think about it. So it's how do you build that infrastructure, very much like the internet. How do you build a communications framework that allows independent parties to communicate with each other in a trusted way and trust the information that's been shared across those networks.
Any quick thoughts, Mark?
I completely agree with that. I don't see there being one solution, but I think so many of the great technologies and the data providers today are able to offer a plug-and-play option through API, so that you can pull in different capabilities into your own onboarding cycle. I think a lot of it comes down to what are the problems you're trying to solve, and dare I say, many organizations probably jump into new technology, into a purchase decision without necessarily thinking about the broader vision of what's the problem we're trying to achieve here. Is it to replace a legacy system because it's at end of life? Are we trying to sort out the customer experience? Is that our most important requirement? Are we trying to drive quality improvements because we know that our compliance processes are not fit for purpose today? Is it efficiency? Are we trying to reduce our costs because we know that this process is incredibly expensive? And I think for a lot of organizations going through that process, going through the initial consultation, making sure that everyone is bought into the vision of where you want to take your KYC and AML practices, what does the mid state and the future state look like, and how are you going to get there? I think a lot of organizations need to go through that process, need to go back to those questions to make sure that the decisions they make on technology are right today, but also right for 5 years' time.
Thank you very much, Mark. Out of curiosity, this question is to Donald. By using the existing KYC technologies, can we use the similar sort of technologies in other domains so that we could eliminate the problem of multitude aspects of passwords? Instead of remembering dozens of passwords, if we just use the same technologies, whenever we have value transaction or whatever it may be, the valuable transaction that we're going to make, can we use KYC instead of using dozens of user IDs and passwords?
I think in theory you could. I don't see any reason why you couldn't. I think for me this comes back to like a broader societal kind of issue, which is historically we've always trusted institutions, and those institutions have issued kind of I guess physical tokens like passports that kind of endow that trust onto you as the individual, and you can kind of use the other examples like university degrees as well. That's kind of one model for society, and that's now kind of, I guess, competing with an entirely different model, which is about decentralization and distributed trust, where instead of trusting in single institutions, you trust in maths or software or the internet or whatever. Look at the whole decentralized finance movement as an example of this. And I think the answer to your question very much depends on what side of that debate you sit on. If you're on the kind of decentralized side, then yeah, you could have digital tokens which represent individuals. You could layer authentication onto that. You could tie it to a physical object like a mobile phone, and then you could use that to exchange identity credentials, exchange value, exchange a whole bunch of things. Or not. And the reality is you're probably going to end up with some sort of bridge between those two worlds where the physical tokens become digitized, and then there'll be multiple different kind of digital trust tokens or whatever you want to call them that you might be able to combine and use to access different services. I think that is a realistic vision of the future.
Yeah. Thanks, Donald. This is to Mark. Can you quickly summarize future of KYC? So in what directions this is going to evolve? What are the possible scenarios?
So yes, I mean, I guess there are many ways that KYC is going to go. Ultimately, we know there will be more digitization, more automation. Will it be complete and comprehensive? I suspect we'll still have, the best technologies, the ones that are going to win out are the ones where there's still the opportunity for human in the loop. So take automation as far as is possible, take machine learning as far as possible, but at some point there's still a requirement for human intervention. I don't think financial institutions are ready to step away from that yet. So understanding how those things can be married together within technology is going to be very important. I think the customer experience piece that we started the conversation with is vitally important in this. If your competitors can onboard a client in 30 seconds and it takes you 6 weeks, then ultimately, at an individual consumer level, we're already seeing movement away to some of the new financial institutions that can offer these services. It's going to be broadly similar at a corporate level as well. So for major corporates that have choices to make between different financial institutions, it just won't be acceptable to take a long time to onboard. And I'm going to call out an example of that we've seen recently. Investec have recently digitized a lot of their corporate account application process, and greatly streamlined the onboarding process. And I know that they've worked with iMeta technology to reduce the onboarding lifecycle, the onboarding workflow, down to seconds, so that the vast proportion, the vast majority of those requests can be done in a digital manner. And that's not just for private individuals who have a passport or maybe a microchip in a few years' time, but that's for corporate institutions. So we know it's possible, we know it can be done, and if you then can manage by exception, and give a seamless experience for firms, for corporates to come and open a bank account, then that ultimately is the direction we expect.
Thank you very much, Mark. Thanks, Donald, as well. Any quick question from audience? Thanks so much. Thanks for your time. Yeah.
Thank you.
Thanks again.
Thank you.